This is question time at Alhambra Investments, and this week we're trying to answer a lot of the questions that seem to be the most prominent thing on people's minds. And Joe Calhoun and Steve Brennan both here. And guys, I want to start off. The investment environment right now seems to go along with an old song from 1965 by a group called the Byrds called "Turn, Turn, Turn." And it seems that a lot of things that, well, really the only thing that was working first half, large cap growth, people are now turning to a lot of other categories. So, Joe, what are you seeing?
Well, first of all, I'd like you to congratulate you on your memory from your DJ days because that's pretty good. Turn, turn, turn. I love the birds. Yeah, look, the first half, if you didn't own large cap growth stocks, you had a pretty miserable first half of the year. But as often happens, it's shifting. Nothing like that. It's rare to see one real specific asset class like that just continue to outperform. Although I have to say the S&P 500 has been pretty amazing over the last 10, 15 years. Um, yeah, I mean the second half so far going from July 1st has been kind of I wouldn't say the opposite. It's not opposite George, if you remember Seinfeld. But it's close, value stocks outperformed. We had real estate, in fact, really outperformed. Dividend growth, which is an area that we really tend to favor, outperformed. I think really the only thing that lagged in the second half has been commodities because oil prices have been hit pretty hard, and have been continuing to get hard, getting hit again today. But yeah, I mean, I think that that kind of comes into our wheelhouse. We're really value investors, and so we like to see things shift back towards our ballpark. I will say the shift has actually started almost 3 years ago, and I think most people just don't realize it because real most recent history was really about these growth stocks. But if you go back and look, value has outperformed over the last 3 years. Dividend growth is not quite that good, but it's really performed great this year, that's for sure.
Steve, talk to us about our dividend and growth portfolio and where we're headed with that.
Yeah, sure. Well, I wanted to kind of react to two things. One is just valuations. Some people are pointing out to how expensive the stock market is, and in some measures historically expensive, and that being a real risk. But I think what's interesting is that yes, the stock market is measured by dollars, where the money is actually pretty expensive. But when you actually look at stocks, the average stock, like the average dividend growth stock, the average mid cap stock, you find that actually they're pretty reasonably valued, and you can even find good buys there. We've just gotten so dominated in market cap by these big, giant, large cap, very expensive stocks that it really kind of moves the entire market. But that doesn't mean that there aren't a lot of good stocks out there. Specifically to dividend growth, one thing I'll just kind of toot Joe's horn for him because it's hard to do it for yourself. But a really interesting approach he took when we look at dividend growth was a lot of these portfolios are constructed by let's get the highest dividend stock companies, or let's look at consistency of dividends. Well, Joe came up with a kind of common sense idea of let's first look at whether it's a good company or not. Let's actually prioritize picking good, solid companies, and then we'll look at how consistent or how high the dividends are. And I'd argue it actually allows you to construct a much better portfolio than the more traditional approach. So don't mean to embarrass you, Joe, but I do think that's kind of a unique way to go after this part of the market that right now actually represents some good valuations, respective to where the S&P 500 is trading.
Joe, you put a lot of work into it. I mean, we've always known dividend and growth was a good philosophy, but you spent a lot of time to construct our take on dividend and growth.
Well, I'm reminded of that old saying about even a blind squirrel finding a nut, but maybe maybe I did get something right here. Yeah, look, let's it's interesting. You look at dividend environment. We talk about environment all the time, dollar and rate paradigm, right? And I think what's really interesting is that one of the reasons we have spent a lot of time on dividend growth is because it's a portfolio that works in all environments. Yeah, as Steve said, there's different types of these portfolios, right? There's high dividend, there's dividend growth. High dividend worked really well in the bear market of 2022, by the way. But other than that, in general, the high dividend stuff it's kind of, there's not a lot of growth there, put it that way. Talking about utilities and things like that. So um, I just focused on what I thought was important, which is the growth aspect of it. If you've got a company with a growing dividend, that tells you a lot about the company just all by itself. But Steve mentioned that we do some fundamental screening there just to find good companies too, and we did. That's part of the process. Uh, we're really proud of the dividend growth portfolio. It's an outstanding performer, and it's really consistent. And it is a little bit different than the other dividend growth or dividend type portfolios that are out there. It'll include a growth stock. If it's growing very rapidly and growing the dividend rapidly, then we don't have a problem buying those things. I think a lot of dividend and dividend growth oriented think only big blue chip and only really staid companies. And we decided, we don't have to be hemmed in by that. If there's a good growth company out there that's growing its dividend at a rapid rate, let's buy it. So anyway, yeah, look, it's done well this year. The Dividend 50, and we run various versions of the portfolio. We can run it a more concentrated version or a more diversified version. We tend to go more diversified, really. We're kind of conservative guys. But the Dividend 50, which is 50 stocks, I think is up 24% this year. It's right in line with the S&P, which is not something you would generally expect from a dividend portfolio. So, the yield is not as high as you might, see in some of these high dividend portfolios. Because the only restriction we put on the dividend yield is that it be more than the S&P 500, which right now is like 1.25. So it's not very high hurdle. But anyway, yeah, we're looking for good quality companies, high quality companies that are increasing their dividends, and we want to hold them for a long time. We want the turnover to be low. It needs to be tax efficient so you can hold it in a taxable account. And we think we've kind of nailed it. So yeah, if you want consistency, I think it's a great place to be.
Absolutely a good thing. And if you'd like information on our dividend growth portfolio, shoot us an email, info@alhambrapartners.com.